Hello and welcome to Property Matters, a weekly look at all matters property designed to be of interest to anyone who has an interest in property. And Property Matters is sponsored by Fairview International and also, of course, Town and Country Property Auctions London. As always, a busy week and a very busy week in terms of mortgages. And this week we have a mortgage special for you. So any questions that you have relating to mortgages, please put them in the comments below and we will try and help you with those questions as we have experts with us today to do just that. Talking of experts, let's start off with our resident expert with us every week, of course, Joe Joshi, sporting a very fetching post-lockdown shaven Barnet.
And I've joined the ranks of the no ties this week for summer. Have you noticed that?
Indeed.
Yeah, just wanted to make sure that we're in the summer mode, and lighten the load on the old head there, Paul, just to get rid of the locks of the lockdown. Good morning, everybody, and thank you very much. And the great show put together ahead today. Great to welcome Bob Singh back from Chess Mortgages. The subject, as Paul said this week, is full on mortgages because basically the government has been doing a fantastic job in assisting the home buyer. The idea of Boris's generation to buy instead of generation to rent is obviously steaming ahead. Rishi Sunak has thrown the gauntlet down this week with the 95% mortgage backed by the government. And that's why Bob is here as expertise in the mortgage side of things, which we've got tons and tons of questions for him. And like Paul says, if you have any, please write in and we'll try and address them. But of course, as always, there's always the general stuff that we want to discuss in property. Property Matters is a program that has been designed simply by what it says, Property Matters, because property does matter. It is the only thing that matters in most of our lives, in all honesty. It's the best form of investment, in my common and standard line, and it's the best thing that you'll ever do in terms of buying. So, and we're here to try and show you and guide you in the right way.
Very well said. Couldn't have put it better myself. But welcome, Bob. And let's just
I wasn't after you a job there, Paul. I just thought I'd tell you that.
So let's just, as I say, we're talking mortgages. So let's talk about the reason why this is so timely. Joe just touched on it, of course. The government launched this week its 95% mortgage guarantee scheme, designed to help those with lower deposits to get on the housing ladder. State the obvious first. They offer incentives to lenders to offer 95% loan-to-value mortgages, many of which were removed from the market, of course, at the beginning of the pandemic. So literally 3 or 4 months ago, you'd have to have been looking to find probably 15%. Is that a fair assumption, Bob?
Yeah, 15% was the standard deposit required to get a good rate. There were still some 90 and 95% schemes, but people didn't know about them because lenders didn't talk about them too much. They still felt it was risky lending. So, but now, because the 95% schemes backed by the government are around, everybody's offering 95% mortgages all of a sudden. So it's now spoiled for choice, but still not as good as last year. I think in January 2020, there were 313 95% mortgages.
Wow,
so an amazing choice last year, but obviously they're now all slowly coming back into the market.
Why do you think the lenders took so long to react? Because obviously they launched the stamp duty holiday last year, middle of the year, and lenders were, it took to the new year for them to get the products there for people to buy. So why were they so rested? They still didn't think there was the market was going to be safe enough for them to put that level of risk out there.
No, they did feel uncomfortable at the 95% level. They only really woke up when the 95% scheme was announced in the March budget. And that was a little too late, to be honest with you. Before, banks were pretty happy doing 90% business, 85% business. And they were comfortable. They still, to this day, are nervous about the new build sector, because even the 95% mortgages that have just been launched, not many lenders want to entertain the new build market. It's primarily for the second-hand market.
Why do you think that is? What's their fear of the new builds?
I think they feel that the market might have been overheating because of the stamp duty cut. People are sort of piling in, buying. So they want to limit their exposure because banks can't lend 95% on every mortgage they do. They have to segment their risk profile. So they'll do some at 50%, some at 60%, some at 75%, and so on. So 95% lending is going to be a very small part of their book. So they're not really worried if they don't lend too much at 95. If I'm honest with you, I think they're just appeasing the government and doing something. But the government, I don't think, consulted the banks before they set out, because it's taken a month or longer for the government-backed schemes to sort of surface after they were announced. I would have expected the Chancellor to have at least discussed the schemes with the bank, so that the day after the budget, these schemes would have been available.
And you can understand,
but we're 6-7 weeks down the line.
And you can understand, Joe, the lenders' worry, because, I mean, you shared something with us last night, didn't you, about a story in Aberdare in Wales where they were queuing outside an estate agent to get on the housing ladder.
Yeah, and that's an amazing story, but it's also resonant to the things that we've been covering throughout our time on Airport, and that is that people see this as their best form of investment. People want to buy; they want to have the security and the surety of knowing their home. Yes, it's a good rental market, and you're actually paying someone else's mortgage. That's how they see it. And obviously, those that have investment properties would not like to see here say that. But the truth is, they too buy them so that they can actually make money out of the investment. So what first-time buyers or buyers are saying, here is a window of opportunity for us to actually get our foot on around the ladder. I agree with Bob's comment about 95% and the fact that the government backed scheme is probably slightly behind. But what it has done is it has motivated the market, and it has motivated those lenders that were sitting back saying, well, we don't want to be taking the risk in lending up to 95%. But what I'd like to ask Bob on that question of 95% are that what are the hidden aspects of that, Bob? What are the guarantee? What is a guarantee when the government says 95% government-backed guarantee? What does a government-backed guarantee actually entail? I mean, are they saying to the lender that we're kind of giving you some sort of security, or are they saying to the borrower, are they giving some? I'm a little bit uncertain about what the guarantee is, and perhaps you will be able to help us shed a little bit of light on that.
The guarantee is actually, the guarantee is to the banks themselves. So should the loan go sour and they have to repossess the property, for example, the government will guarantee up to sort of 80% of the loss.
Right. Okay.
So
that's good and clear.
If you go back sort of 15, 20 years, there used to be a thing called mortgage indemnity guarantee premium.
Absolutely.
Yeah, that was an insurance-backed guarantee to the lenders, and that helped the market sort of go along and help people borrow 95%. But now the government's got involved, so they're saying, okay, lend them the 95%. We'll cover the majority of your losses, but please, let's kickstart the market at 95% lending, and that's what's happened. But I'm not sure if the take up is going to be as big in our neck of the woods, because to get the multiples, it's not really a flexible sort of a criteria for 95% lending.
Yeah, I mean, they do say in the comments this week that this scheme is going to be far more beneficial to people buying in the north than in the south, because prices down here are so restrictive. And a secondary point on that is there's an affordability issue. It's all very well being able to try and apply for a 95%, but then you've got to pay meet the payments every month.
Yeah, I think sub 300 market is going to be quite active with this facility. So if you're on the peripheries of London or whatever, or as you said, North or the Midlands, this scheme is going to be very widely used there, because it does and will help people get on the ladder. Difference between 5 and 10% is, can be quite a lot of money for some people. But I think people are rising or realizing that because prices are escalating all 8% a year now, time is money. So they're now saying, okay, let's get on the ladder now rather than wait a year and pay 8% extra for the same house next year.
Because there is this chicken and egg situation, isn't there? Because Tim Bannister from Rightmove has said this week, that the typical first-time buyer's home has risen £23,000 in 5 years. And last month we had another 2% growth in a month. That's the second time that's happened. 2.1% growth in a month. I mean, the irony of all this is, of course, as we've said before on this programme, is that the money that they would have saved with the stamp duty has gone on the price.
Yeah, I think from now until end of September, up to 250 market is going to be quite busy. I think it'll be driven by the first-time buyers, and 250 buys you a lot of property around the country, except London. So London will miss out, unfortunately, because the affordability isn't there. But the cap is 600,000, which is fine. But
I think, sorry, Bob, I think that's actually, by speaking it out there, we've kind of highlighted maybe the government's agenda, and that's why they're particularly not worried about bringing it in line with the June deadline, because the 250 deadline is until September. And therefore, the drive to get the economy boosted in the north is probably really the hidden agenda here for the 95% mortgages, and the fact that they've got up till September before that sort of stamp duty changes.
Correct.
So I think that we've answered probably our own questions about the 95% part of it, and that is that, but that's been happening anyway, and which is why the queues in I think it was Wales, the queue, and parts of Wales and parts of other parts of the country where prices are much lower. That's where the drive is, and the pandemic has actually helped them by that, because people are thinking, well, actually, I don't need to be, in a bigger city or a bigger town, or accessibility. I can actually do 3 days from home and maybe a day traveling into where I need to go to. So all of those things are driving the house prices right in the north, and in a funny sort of way, quite a clever move, I think, really, to try and balance the scale, because it's always been a London-based thing, isn't it? So I think it's quite good to see that other parts of the country are actually going to see some benefits, and it gives the opportunity for the first-time buyers and anybody else that is moving. There is a twist to that side in my mind, and that twist is that there is a downsizing going on. And again, Bob, it's mortgage driven. The UNIs of the world that took our 25-year mortgages 25 years ago, funny enough, like everything, time is right upon us, and some of those were interest-only mortgages. And yes, whilst house prices have done particularly well in the south, some of those people are now setting up and moving perhaps a bit further afield. That means that they can actually mitigate their interest-only mortgages, take some relief out of that, and almost live freely in another part of the world. So there's a sort of another twist to this whole program that allows people to move up. They don't want to; it's not a choice. I mean, in an ideal world, they want to stay where they are, but it now gives them that question about, well, how am I going to pay this off? Either that, or I'm going to have to sell my house and go and rent. Well, this is a good window of opportunity of those people to say, well, if you need to do that, you need to do that sooner rather than later. Then sell your house and move a bit further afield, and you are probably going to buy something. But give it another 2 years' time, some of those in the north will also become out of reach, because house prices would have risen up there as well. So, it's all a time thing, isn't it?
Yeah, and the suggestion is that prices are rising faster in the north, which is part of the government's agenda to try and level things out more. Let's have a talk about rates for a second, Bob. Suggestions this week that rates are settling on these 95% mortgages just under the 4% mark, with a fix of 5 years. And whilst that's higher than you'd get if you were doing a 90%, which you'd expect, it does mean that the figures work out that you're still paying less than you would if you were renting. And with the fix, of course, those that are challenged on affordability, they've got some kind of a way of planning at least the next 5 years. So it does make sense for a certain niche audience.
Yeah, 95% rates are, say, on average 4% on a 5-year fixed basis. And now compare that with a 90% mortgage of 3% fixed for 5 years. and an 85% mortgage of 2.5%. So you are paying 1% extra on the 95% scheme for 5 years. So really, if you can somehow get your deposit from other sources and make it 10%, it still might hold you in better stead because you'd get a lower rate of interest. Otherwise, you're basically, taking with one hand and giving with the other. That's what's happening with on 95% scheme. You're paying 1% more than a 90% equivalent, and that's the difference in your deposit anyway. So, but it does get you on the ladder. That's the beauty of this 95% scheme. So a lot of people will go for it, of course.
It doesn't sound like a lot, but that 1% over the term of a mortgage, for example, is significant, isn't it?
Yeah, and you're relying on property prices increasing, and therefore, in 5 years' time, not being at 95%, maybe coming down to 85 or 90, because that will then qualify you for a better rate, depending on what rates are then. So you are relying on property inflation to get yourself a better rate the next time round. If we go into reverse and we go negative equity, for example, then you could be stuck on that mortgage. So there is a downside to the 95% scheme as well. It works nicely in a rising market, but it won't work so well in a declining market when you end up with negative equity, which is what happened in the previous crashes. People were left on negative equity situations, couldn't change lender, nobody wanted them. So I'm hoping there's some safeguards in terms of preventing these 95% people becoming mortgage prisoners in the future. So what will happen is they'll go on to standard variable, which is 4% now anyway in the majority. I suppose the good news is the long-term prognosis of interest rates is that they're not going to be rising anytime soon or fast. So, I think rates are going to be pretty low for a long, long time. So that's the saving grace, which wasn't the case in the last crash because rates actually went up.
Yeah, I mean, it's almost laughable. We're sitting here talking about 4% being expensive when we all bought when it was 15% the rate. How we ever afforded it, I'll never know.
No. On my a former business loan, I paid 18%.
Yes, I remember my first ever mortgage payment on a 3-bedroom terrace house was £868 a month in 1990. How I managed to afford it, I'll never know. But here we are where we are now. Interesting, the government said this week 69% of private renters and 63% of people living at home with their parents are struggling to find a mortgage with a low deposit. So in other words, they're really unable to get on the ladder. And I guess that's a phenomenal figure. It's not hardly surprising given what we know, but I suppose these will be the people that could benefit from a scheme like this.
Yeah. I mean, mortgage affordability calculations came in at the time of the mortgage market review in 2014, 2015. And even though we're paying 1%, 2%, or 3% on our mortgage rates, the actual calculation for affordability is done at 7%. So, the FCA in their infinite wisdom said, we want to make sure you can afford this mortgage, even if rates go up to 7%. So they work out affordability on 7%, even though we might be paying 2 or 3%. So they're taking a very, very cautious view. So that's why on these 95% mortgages, 4.5% income is pretty much the standard at the moment. We did hear from one lender this week, nationwide, for a 10% deposit for a first-time buyer, the multiple has been extended from 4.5% to 5.5%. So they've really pushed the boat out and put the cat amongst the pigeons on the 90% market. So I'm sure other lenders will have to follow, otherwise nationwide will get all the business.
But it was said this week, I think it was Tim Bannister from Rightmove said it's important that we have this 95% product, but it's also important that we have a really competitive 90% market driven by the competition, getting rates better and better to help people. My question, Bob, around affordability is, I mean, obviously we're seeing at the moment prices, as we just said, going up last month by 2.1%. So, and you just mentioned that one building society has brought in a product that gives you 5.5 times. How flexible, given that prices are rising so fast, how flexible is their affordability model? So in terms of the multiples they provided, do they change that very rarely, or is that dynamic with what's happening in the market?
The affordability models are fixed. Yeah, they're predetermined by their calculators, and when we key the application in, it will say yes or no to you. They may make the credit scoring criteria less restrictive because they can adjust that. They can accept lower scores to get more business, or when they don't want so much business, they can tighten that doorway so only the very high and the excellent scores get in. But affordability is pretty much fixed. The good thing is not all lenders now work on multiples of income. They work on overall affordability. So with those sort of lenders, you can sometimes get more lending because they look at other factors and they use national statistics to work out how much you can borrow. And sometimes with an affordability-based lender, we know we can get more money.
Let's just have a quick look at our second story this week. And this is around the time it takes to get these contractual arrangements through the sale. A conveyancer saying this week, progressing the pipeline should be the agent's absolute focus at the moment. HMRC has said this week that residential transactions totaled more than 147,000 in February, which is almost up a half year on year, and even 23% on January. And Rightmove suggests that the stamp duty holiday extension could be responsible for an additional 300,000 transactions by the end of June, totaling 175 billion. And they're suggesting that there are a couple of things that people can do to try and bring the average time it's taking to complete these deals through from sort of 140 odd days down to a little bit less. We've only got 70 days to go until the end of June, or just under 70 days till the end of June for the first stamp duty cut-off point. So they're suggesting things like simultaneous exchange and completion, or SIM. Joe, do you want to just tell us a little bit about that?
Yeah, I mean, simultaneous exchange and complete is it's a good route, but the problem is always going to be, are they all ready to do that? And that's where the legal profession tend to lag behind. It's probably a poor excuse of saying that we're not up to speed, and that's why things like simultaneous exchange and completion comes. The problem with that particular part, Paul, in my mind, is not so much the process. The process is good, but it is also the preparation, and the preparation is where Bob will be able to enlighten us on that. When mortgages are involved, there is a separate process that has to get the lender to actually draw down and make sure that that money is in the solicitor's account, ready for him or her to be able to actually do this simultaneous exchange and completion. The problem with this process is that because there are other parties involved, for example, the key party in this is a lender. The reason why the exchange and the completion dates that are set in the current pattern of the conveyancing system is because once a matter has exchanged, the solicitor then to notify the lender to say that I'm going to complete in 10 days or 28 days or 51 days, and I would need the money that you have agreed to lend to this person available in my account by then. And the lenders obviously have money, cash flow scenarios to deal with because they've got loads of money coming in and loads of money going out, and they need to allocate the amount of money that has got to complete. The problem with SIMs is that there has to be a background preparation. Now, my concern about that is that if there's a background preparation that has happened, why have SIMs? Why, to do the simultaneous exchange and completion? And it can only be because the back end hasn't been dealt with correctly. But if the back end hasn't been dealt with correctly, then the simultaneous exchange and completion is highly likely to not happen, and other than the create a massive stress factor for both buyers and sellers to think that they've got to push the pedal to go and get this done, I think is a huge issue, and it's quickly going to crash as it's going to be. I think, Paul, my view on that is that it's a good byword of the market to say that this can happen, and it's a nice way to show that there's another method to try and deal with this. But that method within the current conveyancing system is good as the conveyancing goes, but they have to remember that there are other parties involved. And 9 times out of 10, it's those other parties that actually control the issue. Now, if the lender says, I'm not actually going to be able to give you that money till 10 days' time, then SIMS is not going to happen. What are you going to do then? Tell the client customer, you've got to go get a bridging loan to pay for something that we've now committed to. So it's good, but I would seriously recommend that they seriously think about its consequences. And I'm sure Bob will enlighten me on that point.
Yeah, I think SIMs are more likely to happen when there's no chain, because on a single property it's still possible. You can exchange and complete on the same day because you've already got your deposit. Now, where a seller is selling something to buy another property, his deposit is going to come from his buyer. So then you've got 2 transactions that need to complete simultaneously, and that sometimes cannot happen in practice. People aren't ready for that sort of transactional speed at the moment because our system isn't geared up for that. It's typically, apply for your mortgage, get the offer, exchange contracts, and then set a date for completion, which might be 7 or 14 days or even 28 days hence. So until we all gear up to speed, I don't think that will happen in too many cases.
The point they're making is that if any party in the chain cannot move on the planned date, then they're not liable for costs or risking their deposit because they don't have a contract that's been exchanged. So it protects all sides from having that exchange of contracts and therefore potentially losing finance already committed.
Yeah, it's risky though, isn't it? Would you really want to hedge all your bets on that transaction happening on one day?
Yeah.
When you've got to also do the same thing on your next one, so it could be leading to a lot of disappointment in many cases if it doesn't happen.
Yeah, and they do say it's recommended that there's at least 1 or 2 weeks between both. The other option was exchange on notice, an exchange on notice where the completion is agreed with a notice period instead of a fixed date. So you can say, okay, we've got a notice period of 7 days, but no later than the 30th of June to protect yourself to get the deposit, the duty holiday benefit.
But that then gives them a get-out clause. Let's say something happens in someone's life and they turn around and say, well, I actually haven't exchanged. I've only been given a notice to complete. And circumstances in my life have changed. As Bob says, there are maybe people in a chain. And all of a sudden that person might say, well, this is my get-out. I haven't actually exchanged. I haven't committed. I've got a notice to complete, but I just can't now complete on that day because something's happened in my life. And that's a deck of cards issue for all the other people. In terms of that. I think there are options. I mean, in all honesty, Paul, my view is that the current archaic system can be improved greatly, and both agents and lawyers and sellers can work far closer in order to get that speed right up. In order to meet the timescales that everybody wants to do, and save having to have the stress factor added of doing things like SIM and also these other options, because people end up having to consider costs and consider cost of like maybe a bridging loan, because all of a sudden they definitely want that particular property, but something hasn't happened. So what do you do then? And that's just another minefield, which I'm sure we will go through on another time, but today I think it's just mortgages is a good thing to cover.
I think we could learn a lot from the Scottish system, where the offer becomes binding on acceptance. So at least that buyer is pretty much bound by the terms of the initial offer, and they're more likely to go through with the transaction. And that could be a starting point. I do know some agents are now starting to use a reservation agreement, where there's a small sum of money paid by each party, and if any of them default, they can claw their costs back from the insurance policy. So I think we are taking baby steps into this, but I think the whole system does need a complete overhaul, because it's sometimes not fair on the buyer or the seller when somebody pulls out last minute for no reason, and there's no recourse at the moment according to law, as we all know. So we're in the hands of the gods until that money is put down for exchange of deposit.
So proactivity and positivity is got to be the best option in terms of trying to get these things through, trying to work hard at it and invest your time wisely in moving your chain along, I guess. Let's move on to supply. because obviously this is the other thing that's driving the fuel at the moment on the race for space, as it's been called, as Joe and I have taken from somewhere else, the race for space. Because it's not just the fact that obviously we've got cheap money and benefits from the government in place. The problem with fueling the house prices, of course, is the fact that there is so few houses available. And we mentioned the 2.1% monthly rise that happened in March. Taking the average price, we were talking about this a moment ago, 327,000, just under 328,000 now is the average house price. And that's been fueled by the overheated demand and the lack of supply. So a record high in terms of price, and a record low in terms of stock. So it's official. In March, we had less stock for sale than we've ever had before, and yet we also had the highest house price. Kind of begs the question, gentlemen, that I suppose really, what's the point of all these incentives if you can't get yourself a place in the first place?
True. It could be driving us towards the new build market because there's plenty of new stock available still. So I think maybe that's what, one of the resulting effects of this shortage is that people will then buy whatever they can just to get on the ladder. And I think because of new stock is available, even though it might be hotly contested, I think the market might veer that way towards the new build market and help the developers a bit more.
Why is there a reticence to buy new build? Is it size and that sort of thing, perhaps?
I mean, the feedback I get is that people prefer not to buy new builds unless they're high quality, because generally the perception is that the mass builders do compromise on quality and the fittings. You get lots of problems post build. I know there's a 10-year NHBC guarantee, but that doesn't cover everything. I think people prefer the old and sort of look, the period look sometimes, and most people, in my opinion, may not want to live on a large estate or a block of flats. They want, as you say, outside space. They want a bit of character in their building. But the high quality builders are still selling their stock, pretty quickly, and for a premium.
Yeah. Suki says, I believe the pandemic played a big part in the shortage of supply. And that's borne out actually in comments this week. People saying that a lot of people don't feel safe about having other people in their home until they've had second jabs, and they believe that there will be a rush to put houses on the market once the vaccination program is near to complete. Certainly for the older generation.
Yeah, there is a bit of that true.
Joe, sorry, I should.
Who's going to go?
Go, Joe.
We're all eager. We're all eager beavers today.
Fire away.
Now, I mean, just to cover Bob's point in terms of the new build, I think that the problem with the new build is that, and the problem is financial and space. Financially, obviously, a developer will want to build to the max that he can get on that space. And from a space point of view, we're also building to the max. So when you look at the traditional 3-bedroom semi-detached property, it always offers the scope to extend side, back, loft, etc. Maybe something in the garden. So there's always room to sort of tailor something to your own liking. The new builds are basically maximized and designed in a way for a short term. So you might be there for 3 to 5 years, and then 3 to 5 years you literally have got to move. Now, can I just take you back circa 40 years? And 40 years, the average time that people were living in their property was 3 to 5 years. 5 years was the time for them to move. But those families that were there have actually stayed way too long. Why have they done that? They've stayed there because they've actually managed to extend. So you imagine a 3-bedroom semi-detached house with its own drive to the side and some garden, maybe a 60, 70-foot garden at the back. That family has not moved, they have extended their existing home and stayed longer. So they've ended up having a 4 or 5 bedroom house, a couple of reception rooms downstairs. Maybe the car has actually lost its home because the garage is now gone and the car's been decimated to the front lawn, which is now a concrete pathway. And so that's how that part moved. Now, when you look at a new one, the next generation were actually not interested in gardens because they are, as we talked off air, the millennials are generally maybe earning a lot more money, as Suki would say, but generally they are a lazy bunch because they want everything delivered to their door and they don't want to do any maintenance. They don't want to have a garden. They're not worried about, what it's going to look like, as long as, I don't know, Papa John's could deliver to the door, even though the irony is, as my learned friend said recently, the kids have a shopping across the road, and they still phone them up to deliver it across the road to say that can they do the delivery to the shop. So the desires and the wants of what we have on our wish list as our home have changed, and so therefore, but now they've designed that 3 to 5 year span is back, because in 3 to 5 years, even our young millennials who are sitting at home doing all of this by smartphone will one day go out and go, oh my God, I think I need to have another life, and I better go and sell this place or move from here and move further down, because I've actually met somebody, funny enough, online, because they haven't got out to do it. They've done a bit of online dating, and they've met somebody online, and now they've actually get on the real life of it. So I think the pattern has changed as time has gone on, and that 3 to 5 year time is coming back in. So the new homes, they want to change people to buy those in 3 to 5 years, and therefore they were designed that people will come to a point where go, that's now too small, I better move. Whereas when we were selling houses earlier, 40 years ago, we thought the same, but they said, we can't afford to move, so we'll extend and stay. So the pattern has changed as far as the timing is concerned.
Properties on the market selling faster than ever before. In April, the average time on the market was just 45 days. Almost a quarter of properties that had a sale agreed in March had been on the market for less than a week, which is another record. And 2 to 3 bed semi-detached moving fastest, with 30% of them selling in less than a week. It's quite some statistics just showing the level of frenetic demand and presumably the lack of supply as well. Bob?
Well, the government's been constantly saying, haven't they? Successive governments, Paul, have said they want to build, and they're always behind. Everyone says the last one never built better than I do. I'm going to build more. Social housing has been a big issue. Housing associations have had their scenario. But we have to remember, we are United Kingdom. We cannot expand outwards. We can only go up and use the space that we've got. That's
or down if you're Russian.
Or down if you're Russian. So the reality of it is that we have to live with the space that we have, which is actually a good thing. When you look at it, it's quite surprising how much area is actually built. And so, yes, based on that supply and demand, that's what keeps the interest, and that's not just keeps the national interest, Paul. Not the first time by the people in the housing market. Our program doesn't have a life without property being the thing, but the international market continues to actually fuel our shores, because it is still the most safest haven for them and their families to be in.
Bob, it's interesting that bringing it back to mortgages, that in a dynamic market like that, it's the importance of getting yourself perhaps a mortgage agreed in principle. That must be a wise move if you can do that.
It's always a wise move to be prepared, because what you don't want to do is go out house hunting, fall in love with the property, and then find out you can't get the mortgage. So whenever we speak to somebody, we say, look, get the agreement in principle first, because in this sort of market, the agent is going to ask you, are you ready to proceed? If you've not done any research at all on your mortgages, then of course, you're not going to be favored by the agent. You need to be ready. You need to have that piece of paper in your hand to say you've been assessed and pretty much formally agreed for a mortgage, so that the onward process is made a lot easier. Now, I do know people who don't go and see a property without any preparation at all. They're just wasting their own time, unless they're absolutely sure they'll get a mortgage. But from my experience these days, agents aren't entertaining any viewings unless you have an agreement in principle. So that's really tells you how strong the market is, because the agents no longer want to waste any time with people who aren't prepared. So they want serious people, ready to move people, pre-approved people, so that if the offer is accepted, they know that person can pretty much apply for the mortgage straight away. So, and obviously agents are in the same business as we are. They also want your business. So don't be surprised if you have to go through a vetting process through the agent's broker, because it's their way of getting their claws into your business. That's a pretty harsh way to look at it, but this is how estate agents work, because invariably they have a broker sitting inside the office who needs to be delivered leads. So their intention is always to get you to use their broker. So we often have quite a big conflict where the client wants to use us, but sometimes is forced to use the agent's broker. But if you've done your AIP already, then there's less chance of you being collared and being forced through the vetting process through that guy, which you may not want to go through. So it's good to be prepared. Otherwise, why go down the route of looking at property, making an offer, and then be declined? Sort out the problems before that.
It does beg the question, because obviously they're saying here on today's Conveyancer, they're saying a piece by Jennifer van Derzen. She's saying that obviously there's now less than 70 days, and we were talking about the 140 odd days to complete. So forget it to try and get a property now, basically by the end of June at the very least. But it begs the question: why on earth did the government not bring in these 95% mortgages at the time when they extended the stamp duty holiday at the very least? Bob?
I just think they hadn't thought it out properly. Yes, they wanted to do something that was innovative and something that the market would receive well, but it just wasn't planned in time. So as you can see, it's taken 6-7 weeks for the 95% scheme to come through, and that's vital, because if we're working all towards a deadline of end of June to try and get these things finished, it would have been more sensible to launch this at the time of the budget itself, so people had a good window in which to apply for these mortgages and complete. It's not an automatic process. There's lots of paperwork to go through the mortgage side. Lenders are so picky these days. They ask a million questions, even on straightforward applications. And then you've got the legal side of it. Then, as Joe said, solicitors need some time between exchange and completion. So, before you know it, 70 days is not really a long time, because mortgages can take several weeks to sort out, particularly if they're a challenging set of circumstances. It can take 4 weeks, 8 weeks sometimes to sort out a mortgage. So yeah, I just think it was launched with the best intentions, but as always, they probably didn't consult the banks and to see how it would work in reality, how quickly it could be rolled out. So I think the fear of missing out, FOMO, has played a bigger part in this frantic activity to buy and get on the ladder as soon as possible. But let's see what happens. We've still got until the end of June for stamp duty holiday up to 500,000, and then we've got another 3 months at 250. So I think the market will continue going up and being busy until the end of September at least.
How do you see the market after September, Bob? A lot of people saying it's going to fall over a cliff. Do you subscribe to that?
Partly, yes. I think, when the incentives are no longer there, we'll be returning to a normal market. The stamp duty limit is 125,000. So when that comes, there's no longer any rationale or any reason to go and bust a gut and try and get the property as quickly as possible. Then I think prices would stabilize. I think a normal market will return, but will their prices fall? I don't think so, because there's still a shortage of supply. People still want to move, and for whatever reason, work or schools or whatever, they'll still want more space if they can't extend. And as Joe mentioned, people will be looking to downsize, buying with cash. So I think the market's always going to be there in some shape or form. It's never going to stop. and rates are low, as we've discussed before. You're not going to get lower rates than what we're paying now for a long, long time. So I think market will continue. It may slow down. It probably will, because historically it slows down after September anyway, because of schools and Christmas approaching. People's focus changes, and then it picks up again in spring. So I think we'll not really find out the full effect until spring 2022. That's when I think we'll see what the effect has been of the stamp duty holiday, people going back to work, because the furlough scheme ends also in September. So we'll see how many mass redundancies will happen, and what effect they'll have on the property market, because those people who are currently on furlough, for example, cannot get a mortgage until they return to work. Lenders are being very cautious. They're not using all the income in some cases, but most of the lenders don't want to know if you've got a furlough payment on your payslip. So lots of things are happening in September. You've got the furlough scheme ending. You've got the stamp duty holiday ending. So that double whammy, yes, could slow down the market considerably, or pull the wind from its sails. That confidence could disappear in a very short space of time.
And I guess in all of that, you're saying it's a lot more difficult, or it has been a lot more difficult this last year for you to do your business.
Yeah, we've been busy. It's been very good for every broker in the country, because there's, leads coming in daily. We've not had to do much self-promotion or marketing, and the business has still been coming in. But after that, I think that's where the real test will come for our market. Who can be busy in a quiet market? That will obviously make you stand out if you can remain busy post-September.
Do you think that, Joe? Do you think it's going to fall off a cliff at the end of September?
It probably will fall the end of cliff, Joe. Look, I agree with a lot of what Bob says, but probably disagree with the fact that it will fall off the edge of the cliff. I think that's if you look at the opportunity, it's all about the opportunity, Paul. The opportunity is when you talk about an 8% increase in the value of your home, then it's really got to make you stop and think that, what am I actually saving for, and what's my ulterior motive here? What's my ultimate target? And that is to own a home, whether it happens in this journey. And what is normal? We had normal, over a year ago, and then we had abnormal, and now we got a new normal, and that normal is going to become another normal, and we don't know what those normals actually consist of, because those variants are changing every day of our lives. But the pandemic certainly made us stop and think over the year, and I think that give it 2022, at the end of 2022, you would look back and think, what was pandemic all about? Because hopefully by then we'd move on, and there'll be a new normal or another way of life. But what doesn't change, what has been consistent as far as I'm concerned, is people have always wanted to have the opportunity to own their own home. And at some stage or another during their journey of their life, they will find a way. And where there is a will, there is a way to actually get on and do that. And whilst the government are being helpful at the moment, obviously they have an agenda. They've spent a lot of money, and they've got the housing and the building market motivated in order to keep it going. And they'll build their way out of the problems that they've got of all the debts. Because the amount of income that comes in from, the stamp duty holiday now, but the general income from people owning a home, all the costs that relate to it, all the shopping that's got to go to, all the other industries that rely on the fact that somebody's bought a home, the carpet industry, the timber industry, you name it. All of these people are going to continue to update, decorate, and modernize their homes. And that is what fuels this. This agenda is not just about the housing market, it's what the housing market starts off as a kickstart to the rest of what goes on. So we have a small part to play in, but there's a huge part, as I've often said, that we are the hub of the bicycle. It starts with us, and there's lots of spokes that go out, and lots of people will start to benefit, and that will continue to go on. So then the housing market may slow down a little bit for a little catch up, and other industries will do well because people have bought a home, they have got a mortgage, they've decided they don't want to lose that home, they will go and decorate, they will get new carpets, they'll put new curtains, put a new kitchen in, and so forth and so forth. So, and that will happen for a while, and then all of a sudden they'll exhaust themselves from that point, and they'll say, right, I've done what I need to do here, I've outgrown this place, I need to move again, and off we go again. That is the beauty of the property market that we have in this country, and these steps that they've got, the 95% mortgages, the help to buy schemes, all of these things are helping motivate the market. It has been on the slow, and there's a lot more new homes that are being built left, right, and centre, albeit they are not of the cultural standards that we like. The old semi-detached now with a scope to develop, they are maximised, and so I can't imagine that we'll fall off the cliff, but I think it might slow down a little bit in some parts to catch up in other parts of that, and that I think is quite important. Bob, I have a question for you on mortgages that I'd like you to sort of help and just deal with. The government has been issuing this help to buy scheme across the board, and there are questions on that with not just developers but buyers. What is it that they actually engage? What is the process of this help to buy? What are they helping with? It's all very well to say I've got a 95% help to buy, but what are the nuts and bolts? What does a broker, such as yourself, need to do to make sure that these people that come in with this idea and they're going to get the help? I mean, are there some stipulations? There's sort of differing and varying views, and I just thought I'd ask that question to you.
Yeah, sure. The help to buy is now, quite an established scheme to help first-time buyers to buy new build. Yeah, it's generally was there or introduced to help the big builders in the country to shift stock. As you know, the market did slow down some time ago, and this was a great scheme to help the new build, builders, if you like, sell their stock. Now, this was the 95% scheme. So what the government did was they offered to give the buyer either a 20% deposit or a 40% deposit, depending on whether they were in London or outside London. So you've got the London Help to Buy scheme, and you've got the Help to Buy England scheme. So it was just something to give impetus to the new build market. You have to qualify for it, just like a normal mortgage, because even though you're not putting down anything more than 5%, because the government's coming in with an interest-free loan for 5 years, it was a great incentive to take that benefit, buy something that you liked, but never forgetting that it was all affordability based. So you've got to go through the affordability assessment. If you go on to www.gov.uk and then do a search under help to buy, you'll get a nice little Excel spreadsheet. You can put your salary figures in there. You can put how much deposit you want from the government. And then, given its strict guidelines on affordability, it will tell you what your ideal mortgage size is based on how much you want to put in. You can put in more than 5% as well. You don't have to just take 5. You can put in a bit more money yourself and borrow a bit less from the government. But it's all a fluid formula, and the Excel spreadsheet does pretty much that calculation for you to see whether you can or can't qualify for your mortgage. Because in 5 years' time, that interest-only portion doesn't become interest-free. You have to pay a mortgage part 2. So the second part of your monthly outlay will be the money towards the Help to Buy scheme. So in 5 years' time, you'll have 2 payments. And because the rate is then going to be typically higher on the second part than the base mortgage, most people ditch the Help to Buy after 5 years, providing they can afford it. If they can't, they're pretty much stuck with it, and they have to keep on paying a slightly higher rate of interest than normal. So it's done its purpose. It's worked well, particularly in other parts of the UK. We don't do many here because it's very hard to qualify for it. Now, before, the limit used to be up to 600,000. Now there are regional caps, so you can't buy more than the maximum cap in your region. So I couldn't buy a £600,000 Help to Buy scheme in the Midlands because it's just not that high there. London, yes. So and that website will tell you what your regional cap is. So you can even go on the Help to Buy website and see what your cap is for your area, and then decide, do you want it or don't you want it, and compare it to the normal 95% schemes, because the affordability is pretty much the same. Do you want a third party involved? Yes or no? But we all know this is why the 95% schemes don't cover new build. Otherwise, the Help to Buy scheme would be dead. There'd be no point in having the Help to Buy and the 95% scheme that allowed new build. That's why the 95% schemes don't allow new build loans. They're leaving that to the Help to Buy market. So they're keeping both sides open. They're helping the second-hand market with the standard 95% scheme, and they're helping the new build market with the 95% Help to Buy scheme. So that's why we're seeing, what the Chancellor has done. Quite a clever move.
We've only got a few minutes left, because I know you have to go on to another show, Bob. Such is the demand for your expertise. Great.
Yeah.
But I just wanted you to quickly cover off for us a couple of things. We all know about buy to let, but let to buy is something that, if you can touch on that, and equity release, allowing parents to help with deposits. Those are two of the questions we've had in.
Okay. Let to buy is basically converting your current main residence into a buy to let. So what that means is you can refinance it up to 75% loan to value, and you're basically taking that equity out and putting it as a deposit on your onward purchase. So there'll be effectively a buy to let mortgage. Now, because you've lived in the property, it's a regulated contract, which means there are a few more checks to be done before you can have a let to buy mortgage, because lenders want to ensure that you actually do move out, and you don't just take a mortgage just for the sake of it and pocket the money. So invariably, the conditions of the offer will be that, yes, you can have this let to buy mortgage, but you must buy 37 High Street, Ashford, whatever. So there's normally a clause in the contract. But it gets the money out. It means you don't have to sell the house. So you can break a chain. So if you can afford it, if you can afford the new mortgage with the deposit being raised on the current property, then you don't have to sell. So that's often the starting point for many, many amateur landlords who start their portfolio just by doing that. They do a let to buy and then and then buy the property on a standard residential going forward. So the let to buy is based on rental income. So if it's a good area, good demand, you invariably can get 75% lending on that. So you work out what you can extract from that, put that down as a deposit on the new one, and go ahead with your onward purchase and break the chain. So it's a scheme that's being widely used. It used to be the case that you would get a bridging loan, but that they're quite expensive. But sometimes you might have to do that as well. It depends on speed, because a let to buy is a standard mortgage. It can take 4 or 5 weeks to sort out. But if your need is a bit more immediate, a bridging loan could do the same thing. So it's an evaluation of case by case, but it's a very good scheme. It means you keep one property and you can buy your next one. The downside is you pay a 3% surcharge because you're keeping one property, and that becomes your second asset. So you have to work out and make sure you've got enough money for the stamp duty surcharge as well. And anything above $500,000 if you're completing shortly.
Yeah. And equity release?
Equity release is there for people who are above the age of 55. It's designed for the elderly population to maybe release money from their house, which has been paid off by then probably. Now, equity release is a regulated product. Again, you have to be qualified to arrange one of these mortgages. But they lend on the value of the house, starting off with typically maybe 20, 25% for a young person. By young, I mean 55, 60, 65. And the older you get, the more they're prepared to lend based on the value. Because on an equity release mortgage, the rates are quite good, actually. They're not as high as people think, but the interest is rolled up for life. There's no payments to make, so it's quite a comfortable arrangement for some people, knowing they can extract cash, do whatever modifications to the house they want, not make any payments at all until their last breath. And that's when the company would ask you to sell the house, or your beneficiaries to sell the house and pay them back, or until you go into long-term care. So it's a good way to release some cash, but many people don't like it because they feel they're losing control somehow, or their beneficiaries may not get as much because the interest is accumulating every year. And if you live until the ripe old age of 95 or 100, your initial loan is going to be significantly higher, but the price is going to be higher as well. The value is going to be higher. So these schemes are now quite sophisticated vehicles. They can offer you guarantees. So much design can go around them. So only an expert really should be dealing with that sort of proposition. They're quite complex.
Mm. Well, thank you as always. And I'll leave the final word to David Moyes, who's put up quality broadcast on the world of property. Thank you, David. I'm glad you enjoyed the conversation today. And so thank you very much indeed, Bob. We need to let you go and do your next show and enjoy with that. And thank you so much for your time and expertise. And as always, Joe, fantastic and another great contribution. And I hope everyone enjoyed our show. We'll see you again next Sunday at 10 a.m.